Assalamu alaikum. Welcome to lecture 9 of tax. So from our unincorporated traders, that is your sole trader, we are moving on to partnerships. So the previous three lecture 6, 7 and 8 focused on sole trader. Now lecture 9, and this is the only lecture on partnership because whatever we have studied for sole trader are very much common to partnership. The only difference is we now divide the profit or the loss among the partners. So, under partnership, how do we allocate the trading profit and loss? Then, when the profit sharing ratio changes, what is the impact? Then the capital allowances. This capital allowances I've covered in lecture 7. So, now how it will be allocated. Then, when a new partner enters and an existing partner retires, what is the impact? And when the firm as a whole ceases, then the loss relief for partner, then the limited liability partnerships, and finally the syllabus cover is summary and the technical articles. So, under partnership, how do we allocate profit, admission and retirement of partners, the loss relief, and limited liability partnerships? These are the 4 areas we are going to cover in this lecture. This is one of the easiest lecture and the shortest lecture you will ever encounter. So, a partnership is a group of people carrying on a business together with a view to make a profit. So, the partnership is treated as a single trading entity. A person may be a partner in a firm, but they are still separate taxable person for income tax and CGT. The partner's share of their partnership profit will be assessed to tax as a part of their total taxable profit in the same way as a sole trader. Then, for a self-assessment purpose, the firm produces a partnership return showing their allocated income and gains. Each partner uses their own information to complete their individual annual tax return. Now, allocation. So here, remember the firm adjusts the tax, okay, the profit is adjusted for the tax in the same way as for sole trader. So the adjusted profit and loss will then be allocated among the partners according to the PSR, profit sharing ratio, for that period of account. So this will include partner's salary, interest on contributions on the firm's capital, and the profit sharing ratio that is used to allocate the surplus profit. Now, remember, for partnership, your salaries and interest on contributions to capital, they are not deductible expense of the partnership. Rather, they are just an allocation of profit to the partner. That's how the profit through salary or interest is allocated among the partners. They are not expenses. They will be expenses under sole trader, but not for partners. So therefore, the balance of the profit after you allocate salary and interest will be distributed within the partners in the PSR. Now, after the profit and losses has been allocated to individual partner, then they will be examined based on their taxable trading profit or allowable loss. Now, example 1. So let us understand this through example 1, where the two partners, they start trading on 1st Jan 2024, preparing their annual accounts. Profit share is 60-40. Okay, interest and salary of the two partners are given. Their adjusted trading profit is 140. How this 140 is divided among the partner, we'll see. So open up the two partners account, put the salary of the two partners 30 and 40 and interest on salary. So interest on salary is 10%. 10% on 200, 10% on 150. So 20 and 50. Then remember the profit share. So what is the total profit? 140. If you add this to 2015. So salary is 70, interest is 35. 105, this is the total. So from 140, take 105 out, you are left with 35,000. This 35,000, first, this is number 1. You should always find this. Once you find this, these two are the balance. So this is 2, this is 3. So once you find 35, just divide 35 into 60-40 ratio. Just find 60% of 35 and 40% of 35 and allocate among the two, 21 and 14. And always make sure whether it's correct or not. How? So add this 21 profit with this and check whether it is 71 and 69. Add both and check whether it's adding to 140,000. At the end, you have to get this profit. After you add both the profit, allocation of the partnership profit of both the partners, final answer, you have to get 140,000. That's how you know you are correct. If you're not getting 140, that means there has been a mistake somewhere. But if you follow this order, always start with the total. Then you will get the partnership ratio. So now let us do activity 1 based on facts from example 1. Adjusted trading profit for the period ended were 160. So calculate the trading income for the tax years 23-24 and 24-25. So from our previous example 1, let us draw the two partners J and H. Okay, J and H. And total allocation of their profits, partnership profits. So total allocation of profit. One more line. Total. So here it was 140,000. J was having 60%, 71,000. Of course, it makes sense. He will be having a higher percent, and then 69,000. So now they are asking you the profit for tax year 23-24. Remember, the minute they ask you tax year, first you have to draw the table. Okay, this is for year ended 31st December 2024. Now you have to find for 2025. Okay, so let us do that. We are doing exactly that. So here this will be for 2025 because they asked you two tax years. So now we will start with salaries and then interest on capital at 10%. So here salaries are 70,000, it's fixed, and 30 and 40. This is done. Same. This fat was given in example 1. Then interest 35,000. This also remains same, 20 and 15,000. So now this is 105,000, the total. Now the profit share. So the profit share, when you do it, it would be 160 minus 105. The total is 55,000. If you are taking on a 60-40 ratio, so you can get it straight away 60 into 55, 33,000, and the balance, this is very easy, 55 minus 33, 22,000. Done. So now if you add this to sum function, it should add up to 160, and this is to the sum function 83, 77. So now they started trading on 1st Jan 2024. So from Jan to April 24 is 3 months. Okay. So you have to take in the tax year basis. Now when you take tax year basis, 2023-24. They started trading 1st Jan 2024. So from 1st Jan to 5th April 2024, 3 months. Okay. So you have to take this 31st December 2024, this one, first 3 months, J and H. Okay. So here, when you're taking it, it is 71,000 into 3 months. And then for her, it is this into 3 months. Done. So for the tax year 24-25, that's the next tax year. They are taxed for the period from 6th April 24 to 31st December 24 plus 1st Jan 25 to 5th April 2025. So the next tax year, that is this 24 to 25. Here, the NH. Remember, there are two periods. One runs from 6th April 24 to 31st December 2024. So you have to take 9 months of this and the 3 months from this. You understanding? For this tax year. So it will include 9 months of 71 and 3 months of 83 for J. So here when you are taking this into 3 months plus, let's put a bracket. You have to add this into 3 months. This is 9 month, okay, which runs from April 24 to 31st December. Thereafter, see, it ends on December. Then 3 months, Jan, Feb, March of 2025. So from here, enter, which is 74,000. Same for age here. You have to take this 9 months plus, let's put a bracket. So it is this 77 into 3 months, 71,000. So these are the 4 answers. So this is the answer for activity 1, where we have done the table and got the profit. And here, these are the 2 profits. Now, moving on to changes to PSR, changing the profit sharing ratio. So if this happens, you have to do 2 things: profit and loss before the change and after the change. So before the change, profit and loss will be allocated according to the old arrangement. After the change, according to new arrangement. Now, each partner's share of profit and loss will then be used to determine the individual assessment under the basis period rule for each tax year. So example 2. Here, Janine and Hunter, they have been in partnership since 2012, preparing accounts to 31st March. They receive salary of 50,000, both of them 50,000, and 50-50 their sharing ratio. Then they change the ratio to 70-30 from 1st July 24, and 25 the trading profit was 180. Okay. So now this, what is the salary? Salary is 50. Remember the date for 31st March 25. It is from 1st April 24 to 30th June. Until this date, old sharing ratio. So April, May, June, 3 months only. So 180 when you are taking, this 180 you have to take for 3 months, which is 45. And when you are taking the salary 50, you have to take 3 months. So it's 20. And take into 50-50 ratio. Same for salary. Salary is 25,000, take 50-50 ratio. And this is 45, so the balance is 20. This is number 1. Once you get 20, you know it's the profit sharing ratio is 50-50, so 10,000 each. From 1st July 24 to 31st March 25, ratio changed to 70-30, new sharing ratio for 9 months. So it's 135. So now even the salary 50 you will be taking for 9 months. Okay, which is 60. So this you will divide in 70-30 ratio. Next, capital allowances. So this section assumes the partnership uses accrual basis and not cash basis to calculate their trading profit for tax purpose. So assets that are owned by the firm attracts capital allowances. This we know from our lecture 7. Example on office equipment or cars that are used by partners for their business purpose. Now, regardless of whether the asset is owned by the partnership or one of the partners, capital allowances are calculated on both types of assets for the period of account of the firm as normal and deducted as trading expense before allocating profits between the partner. So we calculate the profit and deduct the expense, that is capital allowance first, then we allocate the profit among the partners. So now example 3. We'll do example 3. There are 3 partners sharing profit ratio 40-30-30. Now, before capital allowances, their profit is 150. So you have one profit and you have to deduct one capital allowance. Now, you have been given the tax written down value of the main pool 10,000 and car 50% business use. COT emission is 60. The reason they have given you this COT emission is to know that this is a special rate pool item. If you're not understanding what is this main pool, special rate pool, please go back to my lecture 7 and do watch my capital allowance. It's very, very important. You need capital allowances for your company, for your sole trader profit, and also for your partnership profit. It's relevant for other areas as well. Without capital allowance, you cannot proceed. Okay, so let us do example 3. So now we need to draw the capital allowances. I'm assuming you know the calculation of capital allowances, assuming you have watched my lecture 7. So I'm proceeding. I'm not going to explain once again the capital allowances. So draw up the table, which is our norm for capital allowance, main pool. Then, because car is having a private use, separate column, car. 50% business use means only 50% you can claim for capital allowance and your total allowances. So now start with your brought forward balance. You start with tax written down value brought forward in the main pool is 10,000 they have given and 18,000 for the car. Nothing goes in the allowance. Allowance is blank. So now what do you need? Remember, this is a car which is having a private use. It is not applicable for AIA, no FYA, looking at the CO2 emission, but it is applicable for WDA. So now, wait, just insert some cell above this. So now here, I'm going to write WDA at 18%. Why 18%? For the main pool. And For the car, 50%, looking at the CO2 emission, it is 60, more than 50. So it will be WD at 6%. And then we will be having a taxation down carried forward to the next year. Now, so when you're taking it, take minus 18% into 10,000. Done. This is an allowance, so we'll write in the allowance column 1,800. Next, minus 18,000 into 6%, and then into 50% because only business use. Sorry, it's 50% you have to take for the allowance section, equal to minus 6% into this. But when we are taking here, we are taking 1080 into 50%. It has to be positive. And then nothing else, just do the sum function and take the total. So I'm going to drag it. And here I'm going to do the sum function, only this two. This is your total allowance, the 2340. Okay. Now, so you need this 2340, which you have to deduct from your 150,000 profit. So now, from 150,000, you will be deducting 2340, which is your capital allowance, this one. So then you get your done. This is your tax adjusted trading profit. This, so you get one tax adjusted trading profit. Now you will allocate this among 40, 30, 30. Okay. So if you take 40% of this, 59,040, this is for K. Okay. Then if you take 30% of this, it is 44,298. It's the same. So copy, paste the value. So this is for K, this is for A, and this is for I. Okay, this is the allocation of profit. Now, moving on to the next question, activity 2. So in activity 2, it's about Smith and John. So this is about capital allowances, including cars that are privately used by each doctor. Accrual basis is written, taxation non value has been given. Main pool 65, CO2 emission is 50, therefore it goes in the main pool. So if you see here CO2 emission, this goes in the main pool, that means WD will be at 18%. 60 business use for Smith 24, and this one 18. Now 1st October 2024, they acquired office equipment costing 25. So before capital allowances, this is their profit, and they have given the profit sharing ratio as 2/3, 1/3, and their salary has been given 50 and 50. Calculate the profit allocation for the period of account. So let us do that. Okay. So here, let us quickly do this. It is for year ended 31st March 2025. Total Smith and Johns. Okay. Now, adjusted profit before capital allowance. So now, what is it? They have given 228,500. So 228,500. Then capital allowance less, because there is a working next to it, I will show this as working like this. You see? So I'm not going to do any working. Then we are going to get tax adjusted trading profit. Never mind, my spellings, there are some spelling mistakes, but it's okay as far as you understand it. Now, after this, the profit sharing arrangement comes. Then comes the salary. So if you see salary, it's 50-50. So salary is 100,000, 50,000 for both. Because it's 50,000 for both, that's how you get 100. Then profit sharing ratio. Okay. So profit sharing ratio 2:1, because they have given 2/3 and 1/3. This we don't know, but this one we'll only get after we get tax adjusted trading profit. For that, we need capital allowance. So now we'll go down to our working to get our capital allowance. Okay. Now, so when we do, we are doing for partners. Okay. So now let's go here. Car, main pool 65, and cars so it is main pool, Smith, Jones, and the total allowance. Okay. Tax did not brought forward balance. So brought forward balance is 65,000 in the main pool, and for car it's 24 and 18. This 24 and 18 are for car. Okay. Next. So additions qualifying for AIA. We'll write equipment and we'll deduct AIA. It's qualifying for AIA. There's a column for it. What is the amount of the equipment? 25,000. And AIA is limit is 1 million, so you can deduct full 25,000. This 25,000 is an allowance. We'll add in the allowance column. Okay. Now, next is WDA. So WDA 18%. Again is at 18%. Again 18%. Nothing at 6% because nothing goes in the special rate pool. Everything is at 18%. So from the main pool, this minus 18% into the 65 minus 11,700. This is an allowance. So immediately I will write in the allowance column. Then even Smith is having 25,000. So here, looking at the CO2 emission, it goes in the main pool. minus 6%, sorry, minus 18% into 24,000. 4320, and here equal to minus 18% into 18,000 minus 3 to 40. Remember the business use when you are claiming. For Smith, 60% business use. So up to 60%. This is 60% you can claim. This one. So when you are claiming here, 4320 into 60% you can claim. 2592. And for John, the business use is 90%. So this 3 to 40, 90% you can claim the allowance, which is 2916. So the total allowance, we need the total allowance. Add all this 4, it's 42208. So this will deduct from our here minus 42208. Sum function. Done. Okay. So now it is 186292. This total has to be here. Just place the value. And this, when you are getting it, does this minus this. Done. So this profit you have to share equally among this into 2 divided by 3. And this one minus this one will get the balance. So the rest all is the sum function. Just add this to, you should be able to get this. So these are the two profits. So this is the answer for example 3. We have started where we have calculated capital allowance, and then we have deducted it from the profit and allocated the profit among the 3 partners. Now moving on to activity 2. So activity 2 also we have solved. Here we have calculated the capital allowance. This is the working. And now third area, when a new partner is entering. So here, if a new partner enters, remember profit sharing arrangement will change. Tax adjusted profit are calculated normally. Remember each partner are treated as sole trader individually. So when a partner is admitted, sole trader takes in their first partner, or as a sole trader takes in their first partner, the incoming partner will be assessed as if they were a new self-employed sole trader based on their share of the firm's profit. So the existing partner, whoever is there, their assessment basis will be unaffected. Only the new partner who is coming, only there will be a change. So example 4 will help you to understand this better. Okay, it's about Ahmed Oliver, who has been in a partnership. Their profit sharing ratio is 50-50. So then later, from 1st Jan, Zain joined. So it's between the year. Then the profit will be split among the 3, 40, 40, 20. So the tax adjusted for 30th June 2024 is 90,000. And then for the year end 30th June, it is 120. So now they have shown you how the profit is allocated. Remember when Zain joined 1st Jan 24. So that means from 1st July, year end is July, okay, 30th June. So from 1st July to 31st December 2023, this falls in the year end 30th June 2024. How many months? 6 months. There are 2 partners. What is the profit? 90,000. So 6 months of 90 in a 50-50 ratio. Okay. Then from 1st Jan to 30th June, this also falls in 30th June 2024. There are 3 partners now. Still 6 months of 90, 40, 40, 20. So we get 45 and then take 40%, 40% and 20%. Then add, get the total profit. So now, if you see for year ended 30th June, it is this ratio. Okay. So what is the profit? It's 120. This change happened in 30th June 2024 in between this year. 30th June 2025, there is no changes the whole year. Okay. That's why you can just take 40, 40, 20 and take this profit of 120 and divide into 40, 40, 20 ratio, which is 48, 48 and 24. Wherever the changes happens, then only you have to divide it into two portions like this. For 30th June 2025, there has been no changes. Okay. So now, what happened here? So as the partnership operates a year end which is not the same as the tax year, you see the partnership year end is not the same as the tax year. Ahmed and Oliver have transition profit of 35,000 each. 20% of which being 20% if you take up 30,500 is 6,300. They are being taxed annually from the tax year 23-24. So now this is the continuation. Okay, this part is a continuation of the question. Example. So here, if they have the transition of profit of 31,500, what happens? Now, this is how for the tax year 24-25 they'll be assessed. So see your 24 runs from 6th April 24 to 30th June. You have to take the June. Okay, because year end is June, it is the continuation of this. You see 30th June. So from 6th April to June, it is 3 months. But it is out of 6 months. Because it starts from Jan to June is 6 months, but from April to June, inside that 3 months of what? If you see 18,000. You are taking Ahmed's. Ahmed is 18,000. Ahmed's profit 18,000. And then from July to 5th April, it is still in the same tax year, which is 9 months of 48,000. 9 months of this one. This 48,000 you have to take. Ahmed's total. Because it is year ended 30th June 2025. So, with the profit of 3 months of the 6 of 18 and 9 months of 48,000, we add the transition profit. Okay. So, transition profit they have given already 31,500, 20%. Why 20%? Because transition profit it is spread over 5 years. When I explained to you transition profit in my previous lectures, I have told you that each 5 years you have to spread the transition profit over 5 tax years. So starting from 24-25, so 5 tax years if you are taking, that means 20% for the 5 years. So 20% of 35 which you will add, and then this is your profit. This is same for both Ahmed and Oliver. Moving to Zain. So when Zain is joining, he's joining from 1st Jan 2024. His profits will be assessed from the start of trading until 5th April. So from 1st Jan to 5th April 2024, 3 months, he will be assessed on the 9,000 profit. Just go back, this 9,000 profit. This is for the 30th June 2024. So from 6th April to 13th June, another 3 months, again 9,000. Then the balance, if you see, year ended June 2025, it is 24,000. So from July to April, 9 months of 24,000. So with 4,500, 18,000 will be added for 24-25 and 22,500. Now, moving on to retirement when a partner retires. That means a partner is leaving an existing firm. Then, last year basis applies to their share of profits only. Remember, existing partners will not be affected. Only the living partner. So the living partner will also be taxed on any untaxed transition profit. Let us do example 5, where there are 3 partners sharing profits equally, preparing accounts to 31st December. Joseph decides to retire on 30th June. Jack and Kel will share remaining profits equally. So here the tax adjusted profit for 31st December 2024 and 25, 210 and 190. So now we'll see this. So, and they have given you the transition profit. See, they will give you this figure in your exam, okay? You don't have to calculate, and you have to take always 20%. So 20% of this is 3,500. This will be taxed annually from the tax year 23-24. That's a rule. Now, so there are 3 partners sharing equally. What is the profit? 210 for this year. But this year, if you see, when is he leaving? 30th June 2024. So from 1st Jan to 30th June, in between his leaving, there are 3 partners. So this 210 profit is annually. But for 6 months, if you take, it's 105. So 105 and 105. So this 105 is divided 3, between 3. That's why 35, 35 and 35. Then the remaining 6 months, this 105 is divided by 2, only this 2, 52,500, 52,500. And for 31st December 2025, there are only 2 partners, so that 190 will be divided among the 295, 95. Okay. So now if you see how he will be taxed on the profit, he is leaving on 30th June. So from 6th April to 30th June. Okay, out of the 6 months, only 3 months on this 35,000. Joseph will be taxed. Okay, so 17,500. He will also be taxed on the remainder of the transaction profit not already taxed. So from 17,500, how much is his profit? 17,500. From here, 3,500 will be deducted. So this is 14,000. Because Joseph is retiring, remember Jack and Charlotte, they are unaffected. So for the tax year 24-25, they will be taxed on the tax year as normal. That is from 6th April to 31st December. Plus 1st Jan to 5th April of the next year. So their taxable profit, if you are saying, taking on this 87,500, only 9 months. And then on this 95,000, the remaining 3 months. It's the same for both Jack and Charlotte because they are having the same profit. So they will also be, they will also each be taxed on the transition profit of the 3,500. Now, when the firm ceases as a whole. So the last year basis applies to all the partners. Now, example 6. So through example 6, we'll understand when the firm itself is. So there are 2 partners sharing profits equally, preparing to annually to 31st March. Okay. The partners retire, partnership cease trading on 31st March 2025. So tax adjusted profit has been given, year ended 100, 3 months 30. Okay, transition profit is 12,500 each. So if you are taking 20% of it is 2,500. Now the trade ceases on 24-25. So the remaining transition will be taxed on the 2 partners in this tax year. So now this is how. So from 12,500 deduct 2,500. This 10,000 is the transition profit. Now from this 100,000, remember it starts from April to December. So from April to December, how many months? 9 months. and you have to take half. Why half? We are doing for each partner, that's why. This 100,000 is for both the partners. Okay, so 37,500. For both it is same. Then from 1st Jan to 31st March, it is this 30,000. You have to take again half because 30,000 is with both the partner. And then so for one partner it is 62,500. For the other partner also it will be 62,500. Now activity 3, you have to show the allocation of profits between the partner for year ended 31st October 2024. Calculate the trading income assessment for each partner for the tax year 24-25. So this is about 3 partners preparing accounts to 31st October. On 30th April, Paul is resigning. On 31st October, the 2 partners are dissolving the partnership. That means cease trading. So the adjusted trading profit is 250. So now the profit sharing ratio has been given 50-25-25 and profit has been given 50-40. And then from this, when the partner left, ratio is 50-50 and transaction profit has been given. Okay, of which 20,000, 20% for tax in 23-24. So now let us solve activity 3. So for this, we have to draw the table for the 3 partners. So here, the total Piper, Paul and Quincy Q. And this is for year ended 31st October 2024. So if you are taking from April, okay, to 30th April to 30 April, just see. So on 30th April 2024, Paul is resigning. Okay. So how many months? 6 months, right? Here it is 6 months. Remember, you have to first get the total. Just deduct. So here you have to take 6 months of 250,000. Because if you take from 30th April to 31st October, see, adjusted trading profit for the year ended, okay, 250. So from, if you say, take from 1st October 2023 to 30th April, you have to take, it is 6 months. So you have to take 250 of 6 months, which is here. Here, this is the total. So 6 months of 250 thousand. It's 125,000. Here it is salaries, and this is the, sorry, that's 120. This is the balance. Balance is the profit. So here, when you're taking the salary, salary is for 6 months. But first you need the salary. Okay. So what is the salary? The total salary. First you need the total salary here before you could find the balance. Because without the salary, you can't find the balance, and it's for 6 months. So this one, if you see, it is salary per year. Okay, if you take for 6 months, for Piper, 50,000 will be 25,000. Then for Paul, again, it's 20,000 because it's 40. So for half, it's 20,000 each. So here, just the sum of this three. Done. Now this one will be this minus, done. So this 60,000 will be divided into, ratio has been given 50, 25, 25. So when you are taking, it is 50% of this. Then 25% of this. Here it is this. Done. So now this is to 30th April. The next one will be let's copy paste this. Okay. So here it is to 31st October 2024. That means from April to October. Again 6 months of 250. So this one will be same because it is 6 months. But this time the salary changed. You see, it is 60,000 and 60,000 salary. So this time it is 60,000 for Piper. Sorry, half, 30,000. So 30,000 you have to take. I'm sorry. 30, Paul exists, and here it's 30. So 30 and 30 is 60,000, and this remains same. So this then becomes 65,000 because the balance. So this, remember, it's on a 50-50 basis. So 50% he leaves. So this will be 50% too. 32,500, 32,500. Now, so part A is done. We have allocated the profit. Now we are moving on to part B. Assessment for tax year 24-25 for the three partners. Okay. So now let us quickly do that. So first we'll do for Piper the assessment for the tax year 2024-25, and it is ceasing in 2024-25. First let's do for Piper. Now, so now first the partnership profit. What is the partnership profits? Remember your tax year, okay? It runs from which date to which date. It's very important. If you see here, on 30th April 2024, Paul resigned, and on 31st October 2024, they dissolved the firm and ceased trading. So 31st October 2024 is the date. So when you are taking till 31st October. So from 1st April 2024 to 31st October 2024, you're taking the profit. So here, when we go, which profit should you take? We forgot to take the sum function here. Okay. So it's 117,500. This is the profit till 31st October 2024. This one. So now, here when we are taking, it is this into how many months? From 1st April to 31st October, it is 7 months. As you can see, I'm going to drop down the decimal. Now, the transition profit. So the transition profit is already given. It is 48,958 for Piper. 48,958. And from here you have to deduct what has been taxed in 2023-24. So equal to minus 20%. 20% has been taxed in the previous year. This will drop down the decimal. So here, let's do the sum function. And here we have to add tax. Done. So it is 107, 708. This is what will be assessed in the tax year for Piper when he has ceased trading. Now, Paul. So let's change this to Paul. Same period. So for Paul, remember when did Paul entered? On 30th. He has resigned. 30th April he has resigned. So here, when we are taking Paul, Paul's profit will be from 1st April to 30th April. April. So it is based on this 35,000. Okay. So here when we are taking into how many months? Only 1 month, from 1st April to 30th April. And how many months did he work for? From April to October. So May, June, July, August, September, October, 6 months. So total is 6 months. 5833. Now the transition profit has been already given. It is 29,167. 29,167. And here it is 20% of 29,166, which is 5833. And finally this is left. So the remainder of the transition profit to be taxed on cessation is this for Paul. Now we are moving on to Quincy. Q. So Q's partnership profit is 97,500. This also, if you take from 1st April to 31st October, how many months? 7 months. So it is this, and then 7 months. Now the transition profit for Q is 4625. So automatically they have taken 20% of this and deducted, and this is the transition profit that will be taxed on when they are ceasing on Quincy. So this is the answer for activity 3 when the partnership ceases. So the 3 partner. First there were 3 partners and then there were 2 partners. So we have taken and calculated, and then we have done the assessment for the tax year 24-25, the transition profit which they will have to be taxed, all the 3 partners. So now we are moving on to the trading loss relief for a partner. Remember, a loss will be allocated between the partners in the same way like a profit. Okay. Now, so the partners can claim for the loss relief as a sole trader. So for established business, you can choose between the more immediate loss relief. Okay, that is against your total income. You can, with addition to that, you can claim against the gain or without the relief against the gain, and you can later carry it forward against future trading profit. Now, all partners of a new firm and a new partner of an existing firm may claim the opening year relief Okay, which relief? The opening year relief for the loss of any of the first 4 tax years of assessment. So from the time when you start, in the first 4 tax year of assessment, if you are making a loss in any of those 4 tax years, you can claim an opening year relief. All the partners in the new firm can do that, or the new partner in an existing firm can claim this opening year relief. Now, what happens when a partner leaves? So where a partner leaves a firm and they have been allocated a loss before their retirement, what happens? So they can claim the terminal loss relief against their share of trading profits for the final and the preceding 3 tax years of their trade. This is the same way. But they cannot claim to carry forward the loss. Why? As any carry forward is only against future profit of the same trade. But that firm will no longer be part of the firm. So you can't carry forward. If the firm partner retires, he can't carry forward his loss against the profit, trading profit. So if the firm as a whole ceases trading, all partners can make the terminal loss relief. Now, activity 4. So there are 2 partners, Flight and Bird. They have commenced trading on 1st April 2022, sharing profit and losses 55-45 ratio. So adjusted profit and loss has been given for the 3 tax years. So here he has made a loss 23, 24, 11,000. Now calculate in respect of each partner their share of trading profit and loss for all the years and their trading income. Assessment for 24-25. Then indicate the alternative reliefs available for each partner share of the loss. No calculations are required. You see, you have to indicate. You don't have to do any calculations. So let us quickly do activity 4. Now, so we'll be doing activity 4. This was the answers for previous activity, activity 3. So here only we can change. Now, remember allocation of profit and loss for the 3 years between the 2 companies. So here is total. We'll just change the light and bar. Just change the name and this will delete. Okay, so here remember this one. Here it is 31st March 2023. So this is 31st March 2024. This is 31st March 2025. Done. So what is the total? 16,800. 16,800. So when you are finding the ratio for flight, it is 55%. Equal to so here when you are finding, just simply find this minus, sorry, this minus this, the balance. Now here you are making 11,000 loss, minus 11,000. So here when you're taking this 55 and this one 45. So you see automatically it is taken, and here 10,500 is the profit, isn't it? Go back up and say yes. So here 55% is done. So now we have done. When we are allocating the tax year, remember in the tax year of loss his profit will be 0. Okay, So for flight, if you go, this is the profit. Here it will be 0. Here it will be this. Then for bar, this year, this is the profit. Here it will be 0, and this is the profit. That's it. Now they asked for second part. They asked no calculation but alternative reliefs. So if you see, both the partner are having loss in one tax year, that is 23-24. Okay, so they can, number one, they can claim against their own total income of 3 consecutive tax years on a FIFO basis. Why FIFO basis? Because the loss is in one of the first 4 tax years of the trade. So from 23-24, go 4 years back, go 3 years back. So 2021, 22-23, and 23-24. Now next, against own total income of 23-24 or the previous year 22-23. Then against, so carried forward, then against first future trading profit of the same trade 24-25 and the later tax years. So this is the answer for activity 4, and this is the final question. So you have seen that we have divided the profit and loss, allocation of profit and loss. Then when we assessed, say it is this 9240, then because it is a negative, it's a nil here, 0, and then 5755. Same for him. So it is in the tax year 23-24. This is the year of loss. So now they can claim against own total income for 3 consecutive on a FIFO. Then against their total income on 23, or go back to 22-23, or carry it forward for 24-25. Now the last part, the 5th part of this lecture, which is LLP, Limited Liability Partnerships. This, in under LLP, partners will be treated as a separate legal entity in which the partner's liability for the firm's debt will be limited to their fixed capital. This is very much like company when companies are incorporated. See, what is the disadvantage of sole trader and partners? The disadvantages are their liability is unlimited, but for partners their liability is limited. That is the protection that company gets. Now they have introduced limited liability partnerships. So under LLP, partners will be treated like companies. Even their liability will be now limited. But they will not ask any calculation part on this thing. You only have to know what is the meaning of limited liability partnerships. This is just one line that is added here. So with this, each partner will be taxed on their individual share of the LLP's profit, applying the rules already discussed. So we have finished all the rules, the same rule. The only thing is this is limited. So whether it's a limited liability or not, question will specify. So that's it. With this, we finish the syllabus part B, income from self-employment. We have touched partnership and limited liability partnership. We have compute the how partnership are assessed to tax, then allocate the profit when there is a change in the profit sharing ratio. For example, either they are leaving, they are entering, or in the middle they are changing the ratio. Then how the profits are then assessed after the change. Then the loss relief for the partners. So let us summarize. We have started with the profit share. Okay, so in the same way, a partner is a partner. Okay, a partner in a partnership is assessed on their profit share in the same way as a sole trader. Okay, in the partnership, two things: salary and interest on capital contributions are there. They are not expenses. They are not trading expenses under partnership. Then once you take your salary and interest on capital contributions, which will be given in the question, the balance of profit you have to find out. They will give you the total profit. So you find the balance of profit and allocate based on the profit sharing ratio among the partners. Remember, when you're taking the balance of profit, it is after salary and interest on capital, not before that. We have done questions. Then the profit shared is an adjusted trading profit. And if there is any change during the period, it is time apportion. And remember, the profit share is an adjusted trading profit after capital allowances on the partnership's asset. Okay, we have done that too in this lecture. So an incoming partner will be treated as he's a newly self-employed sole trader. Then if the partner is outgoing, he's leaving, last year basis will apply. And the remaining partners unaffected. And the untaxed transition profit must be taxed on the partners when they retire on the partnership. This we have done. That 20% of the transition profit. Transition profit will be given to you. Take 20% and deduct from your transition profit. That is the amount that we will be taxed when you will retire. We have done it when the partnership was ceasing. Then partners can claim the loss relief in the same way as sole trader. Okay. Then if a partner is leaving with a loss, they can choose any type of relief, including terminal loss relief. And in terms of where the partnership ceases, all the partners can make that claim. And LLP means it is limiting the partner's liability to their fixed capital. So the technical articles, there are no technical articles for this lecture. Thank you for watching, and I shall see you in the next lecture, that is the national insurance contribution. And also that is going to be the last lecture under income tax, because after that I'll be moving on to the next tax, that is capital gain tax, the second type of tax we are going to study in taxation. Thank you for watching, and I shall see you in the next lecture.